Hi, everyone. I'm Michelle Jakubowska, Marketing Associate at Ramapo Wealth Advisors. Thanks so much for joining us today for our April 2026 market update. I'm here with Wealth Advisors James Sahagian and Alex Tierso, along with our Registered Client Service Manager Ian Bin Lin Sim. All three are certified financial planners, and we're excited to have them here today. Today, we'll be diving into where valuations stand today, what's driving earnings growth, and the increasing dominance of top companies, how alternatives can enhance portfolios, and why both institutional and private investors are increasing allocations, how a surviving spouse can face higher taxes despite lower income, and strategies like Roth conversions and estate planning to help mitigate the impact. And lastly, we'll introduce Wealth.com, a digital estate planning platform we're bringing on board to help you easily create, visualize, and manage your wills and trusts in one secure place. So, James, where do things stand in the market today?
Thanks, Michelle. Good to be back with you and our team for our April market update. We're recording this podcast today on Friday, April 24th, 2026. U.S. equity markets have been quite choppy thus far in 2026. The market began trading relatively flat for the first 2 months. After the war with Iran began on February 28th, we had about a 6 to 7% drawdown from the mid-February peak to the bottom that was achieved in mid-March, and have since recovered all index losses and are currently up low to mid-single digits year to date, trading near all-time highs for most major market indexes. The chart in front of you shows the S&P 500's forward PE, price to earnings ratio, while the table contains additional valuation metrics and their 30-year averages. Although stocks are trading well above their historical averages and are not cheap, there's persistent and growing optimism that a strong earnings outlook and improved productivity can drive the market even higher. The chart in front of you on the left decomposes S&P 500 earnings growth into the contributions from margins, revenues, and buybacks. The chart on the right shows quarterly profit margins since 2002, indicating that U.S. companies have become more profitable over time. The majority of the earnings gains in 2026 are anticipated to come from both revenue and margin growth, a healthy sign. This has been boosted by inflation, a positive for Wall Street and a negative for Main Street, stimulative tax policies, and pro-growth government policies for businesses. Think about the One Big Beautiful Bill, the CHIPS Act, the infrastructure bill, where trillions of dollars were committed to benefit American businesses. This divergence of fortunes has led many to have called it a K-shaped economy, where there's a clear divide between winners and losers. On the chart in front of you here, you'll see that as in the past, the growth being experienced in the economy, the stock market, and in society as a whole has not lifted all boats together to the same degree. The chart on the left shows that the forward PE ratio of the 10 largest companies in the S&P 500, the other 490 companies, and the index itself. It is noteworthy that we are in one of the most concentrated markets in history, with the top 10 companies now making up 38% of the market cap of the entire S&P 500. The chart on the right shows that both the weight of the top 10 companies and their share of the index level earnings have increased together over the past decade. This suggests that there are fundamental reasons for the concentration in market cap. This chart shows the largest 10 companies in the S&P 500 by decade, starting in 1985 and ending in 2025, as well as a bar for the current. The color coding highlights in which of the shown years the company first entered the top 10. While some companies remained in the top 10 for 30 years, others didn't last a decade. As we look forward to the coming years and decades, I think we should anticipate even more rapid change. Many of the future top 10 are likely not even publicly traded companies today and will likely make their debut as publicly traded companies in the coming weeks and months by widely anticipated initial public offerings. Companies like SpaceX and OpenAI are expected to come public this year, with market valuations approaching $1 trillion in the case of OpenAI and nearly $2 trillion in the case of SpaceX.
That's really interesting, James. It appears that there are numerous factors in play which can lead one to being concerned about the current valuations in the market or being optimistic for earnings growth and improved productivity. What role is private equity playing in portfolio construction for individual and institutional investors?
That's a great question, Michelle. We receive a lot of questions about how alternatives can be used in the context of traditional portfolios. In general, an allocation to alternatives should be outcome oriented. In other words, step one is identifying the challenges you are trying to address, and step two is allocating to the asset that will provide the desired solution. Generally, however, this chart shows that adding a diversified sleeve of alternatives, private real estate, private equity, or private credit, to traditional stock and bond portfolios can help manage risk and improve return. Alternatives can both diversify traditional stock bond portfolios. Given the fact that the number of publicly traded companies has been cut in half over the past 3 decades, from a peak of over 8,000 publicly traded companies in the mid-90s to the current number of just slightly over 4,000, it behooves investors and advisors to look beyond the public markets. This is not only due to greater growth opportunities, but also for diversification and risk management.
So, with more and more companies deciding to stay private longer, and with more companies receiving financing from private lending sources, how significant has the growth been in alternatives in recent years, and what is their outlook?
The slide in front of you shows the significant growth of alternative assets under management since 2000, as more investors and institutions have increased their allocations across all asset classes. In particular, the large drivers of this growth in assets under management include private equity and hedge funds for their alpha and diversification benefits, while sectors such as infrastructure are seeing substantial growth in recent years from a lower base. Institutional investor positioning. Alternatives make up a significant allocation in institutional portfolios. The institutional investor we're referring to include pension plans, family offices, corporate investors, university endowments, nonprofit investors such as churches, temples, or foundations. The historical outperformance of alternatives over longer time periods aligns with institutional timeframes and performance goals. Survey data indicate that the majority of institutional investors are planning to maintain or increase their allocation to alternatives over time. On the right side, on the chart in front of you, we show long-term alternative allocation plans by institutional investors. In all categories of alternatives, the majority of investors plan to maintain or increase their allocation over the next year. Private debt, private equity, and infrastructure are leading in terms of net increased allocations.
Has the same growth in alternatives been experienced with individual investors allocating more to alternatives like private equity and private credit?
Allocations to alternatives today vary significantly between categories of investors. Very high net worth investors and family offices have allocations similar to institutional investors, as they tend to have longer time frames and low needs for immediate liquidity. Among private wealth investors, allocations are growing quickly from a low base, driven by innovation in products, broader accessibility, and the attractiveness of higher long-term performance. Evergreen funds have played an important role in broadening the accessibility of alternatives, offering better liquidity, lower minimum investment amounts, and lower investor eligibility requirements than traditional drawdown funds. Just to clarify, Evergreen private equity funds are open ended investment vehicles with no fixed lifespan, allowing for continuous capital raising and periodic investor redemptions. Drawdown private equity funds, also known as capital call funds, are investment vehicles where investors, known as limited partners, commit a total amount of capital upfront, but only transfer funds over time when requested by managers, known as general partners. These funds typically have a 10-year life with 3 to 5 years for making investments, known as capital calls, to buy companies, pay fees, or cover expenses. Back to you, Michelle.
Thanks, James. Alex, I know today you wanted to speak about the widow's tax. So, what does that mean?
Yes, hi. Thank you, Michelle. So today I wanted to spend some time, as you mentioned, on a topic that is relevant for all of our married retirees who have tax deferred or pre-tax balances, as well as those that have various guaranteed sources of income, such as a pension. While this is relevant to all married retirees, it's even more relevant because it more heavily impacts you for those couples that have large age gaps between the two spouses. Or if there's a high probability of one of the spouses outliving the other by several years, meaning you'd be alone in retirement for several years, potentially due to underlying health condition or something like that. So, as you mentioned, Michelle, we call this the widow's tax. And the root cause of this tax shock is a change in filing statuses. In the year one spouse dies, the surviving partner is still able to file a married filing jointly tax return. But after that year, most survivors must file as single taxpayers, assuming they don't remarry before the year ends. So the change in filing status immediately cuts the available standard deduction, which I'll show you in an example here in a moment. It cuts it in half because the tax code implicitly assumes that a household's income will be reduced by half after a spouse's death. So for many retirees, this assumption simply doesn't hold. A surviving spouse may inherit their spouse's larger Social Security benefit. They'll still continue to receive pension income at either 50, 75, or 100% of the other spouse's pre-death level. And they'll have to continue to be responsible for taking the RMDs associated with retirement accounts that have accumulated over decades. In some cases, RMDs might actually increase, after the passing of one. So the result is a compression of income into narrower tax brackets, often pushing the survivor into a higher tax bracket. So let's look at an example. If you were to earn $100,000 as a married filing jointly couple, well, that would put you in the 12% tax bracket. In the very next year, if you were to have earned the same amount of income and your spouse passed away and you are now filing as a single tax filer, well, you have now increased from the 12% to the 22% tax bracket, right? Same amount of income, nothing's really changed, but you are now paying 10% more in taxes due to having to file as a single tax filer. Also, you'll be getting a lower standard deduction. Let's do it at a higher level to see how it affects different kind of classes of households here. So what if you were earning $250,000 as a married filing jointly couple? Well, now you're in the 24% tax bracket, so higher than the 12%. How would that affect you if you moved from a married filing jointly to a single tax filer? Well, you would jump 8%, right, from going from 24% up to the 32% tax bracket at the same level of $250,000 per year worth of income. So now you can get an idea of why it's called the widow's tax. You're paying higher tax rates on the same levels of income. Next slide, please, Michelle. So in the planning community, you'll often hear large pre-tax balances referred to as tax bombs because once RMDs begin, you are then forced to begin taking annual taxable distributions that tend to rise each year. So I say tend to because the RMD calculation is a function of the balance of the account. But assuming the IRA balance was to remain constant, then each year that passes, your RMD would rise. So the widower's tax refers to not only will your RMD amount rise, but you're going to be in a higher tax bracket once again because you are filing as a single tax filer. So let's look at this example of we have two hypothetical individuals here, Bill and Beth, and I think we should probably click in a little bit here because it's a little tough to read. Thank you, Michelle. So we have Bill and Beth, a retired couple in their early 70s. And before Bill's passing, the couple's earnings placed them comfortably within the 12% marginal tax rate, resulting in $9,543 worth of taxes. After Bill's death, Beth was able to file as married a couple for just one tax year, temporarily keeping her in that bracket. But 1 year later, she jumped into the 22% bracket and her taxes went up. So we'll just go through column 1 and then column 2. So we have Bill's Social Security benefit at $40K, Beth's Social Security benefit at $16,000, Bill's pension at $24,000. He was working a part-time job, earning $20,000, and they were withdrawing money from their 401k or IRA of $15,000 for a total adjusted gross income of $115,000. As you can see, the standard deduction reduces your adjusted gross income by $31,500, leaving your taxable income at $83,500. If we move to the next column, we'll see how one spouse passing will affect the household taxes. So we have Bill's Social Security income. You will always keep the higher of the two when one spouse passes away. So Bill's will stay on, even though he's no longer with us, and Beth's will go away. The pension, in this case, it looks like Bill and Beth chose a 50% survivorship. So Beth is now collecting half of Bill's pension benefit. Beth has picked up a part-time job to make up for only having half of his pension and him no longer working. She's working a few hours a week, earning $10,000 per year. And she's had to increase the IRA or 401k withdrawals again to make up for some of that lost income. So she bumped that from $15,000 to $30,000. So overall, Beth is only receiving $92,000 as compared to her previous $115,000. Remember, in retirement, just because one spouse passes away doesn't mean our costs get cut in half, right? So she still needs $92,000 per year. But what happens here? Instead of getting standard deduction multiplied by 2, because there's 2 individuals, it's only one standard deduction, right? So her taxable income, the delta between her adjusted gross income and taxable income is only that $15,750. So her taxable income is $76,250. And she's in the 22% tax bracket, paying a higher amount of taxes. So Beth has earned meaningfully less, and she's also now in a higher tax bracket. So as you can see, this is why we refer to it as the widow's tax. So what is one able to do to address this? Well, in an ideal world, proactive couples can use their time together to plan ahead for the possible tax consequences of a spouse's death. So this is where proactive planning comes into play. Last month, Yan spoke about our tax planning tool that allows us to get a clear understanding of where you sit within tax brackets. Proactive Roth conversions, if appropriate for your individual situation, shift money out of your pre-tax accounts and into your Roth accounts, where you're able to take advantage of tax-free compounding of your wealth. Remember, Roth accounts are not subject to R&Ds because that money has already been taxed. So Roth conversion strategies span a few different areas of planning. It's helpful with income tax planning, longevity planning if one spouse is going to outlive the other for several years, and of course estate planning, because ultimately your heirs will be able to continue to let inherited accounts compound tax-free for an additional 10 years. So this is something we're constantly exploring for our clients to ensure that we're protecting the surviving spouse from paying unnecessarily high taxes when they will eventually have to file as a single taxpayer. I'll turn it back to you and Yan Michelle to close out.
Thanks, Alex and James, for all those insights. I'll now pass it over to Yan, who's going to introduce you to wealth.com and share some of its key features.
Thank you, Michelle. To close out today's episode, I want to shift gears and talk about something just as important as growing your wealth, and that's protecting it. We often see a common hurdle with clients where everyone knows they need an estate plan, but the process feels so overwhelming that it stays on the to-do list for years. That's why we've started using a platform called wealth.com to help create estate planning documents and enhance the value we provide in our clients' overall financial planning. Wealth.com offers a modern digital approach that removes those barriers and helps clients create and maintain their documents in a way that actually fits their lives. So when we talk about an estate plan, we're really looking at 3 core documents that protect you and your family. And today, I want to take some time to give you an overview of these documents. The most common one people are familiar with is a will. A will is essentially your instruction manual. It outlines who receives your assets, who is responsible for carrying out those instructions, and crucially, who would be the guardian for minor children. It's about providing clarity for your family during a difficult time. The second document is the power of attorney. This is the here and now. It allows you to appoint someone you trust to handle your financial matters, like paying bills, managing accounts, or making financial decisions if you're unable to do so yourself. Without this, your family might have to face a lengthy, expensive legal process just to step in and help you. And lastly, the third one is your health directive, sometimes referred to as a living will. This ensures your medical wishes are respected and appoints someone to make decisions for you if you can't communicate. It's one of the kindest things you can do for your family, removing the weight of uncertainty during a crisis. Together, these 3 documents form the foundation of an estate plan, not just for transferring assets, but for making sure decisions can be handled smoothly if something unexpected happens. Now, this is where Wealth.com changes the game. Instead of traditional, often clunky process, Wealth.com provides a guided digital experience. It walks you through these key decisions for wills, powers of attorney, healthcare directives, and even trusts, while allowing us to ensure every detail aligns with your broader financial picture. Because it's a digital platform, your plan can finally evolve as your life does. Whether it's a new child, a marriage, or changes in tax laws, Wealth.com makes it much easier to revisit and update your documents. You don't have to restart from scratch. We can update your documents in real time so they never become outdated. Ultimately, this isn't just about paperwork. It's about creating clarity and, more importantly, giving both you and your family peace of mind. So if you've been putting this off, or if your documents haven't been reviewed in years, don't let them sit on the back burner. We provide full service to this platform for our clients, and we're here to guide you through every step of the process. So here's my call to action for you today. Reach out to your advisor this week. Whether you need to create your very first set of documents or simply want us to review and update your existing ones to make sure they still align with your goals, let's discuss this with your advisors. At a minimum, we'll help you put the core pieces in place: a will, a power of attorney, the healthcare directives. All 3 can be completed together in a way that's simple, efficient, and cost-effective compared to traditional methods. That's all today. Thanks for listening. And if you're ready to protect what you have built, our team at Ramapo Wealth Advisors is here to help. Back to you, Michelle.
Thanks, Yan, and thank you to all who tuned into our April market update. If you have any questions, feel free to reach out to your advisor. And as always, let us know if you'd like us to send over today's slide deck. We really appreciate you tuning in and hope you have a great rest of your day.